In this video, we're going to use some backtesting software to see what happens when we buy at the opening price for the S&P 500 futures contract and then sell at the closing price of the exact same day. The reason is because we want to see what's happening to the equity markets intraday and see if we can't learn anything that we might be able to use in building a future trading scenario or trading model. Let me show you what this looks like on the charts. So for this day here, we would be buying at the left hash mark or the opening price and then selling at the right hash mark or the closing price of the exact same day. And we're going to do that every single day, never holding the position overnight. Now, let's fire up this software here. Okay, some of the criteria that you should be familiar with is that like I said earlier, we're trading the S&P 500 futures contract, just the pit session. We're going to use a trading range of January 1st, 2001 to January 3rd, 2011. We're setting up a $45 round turn commission. And I've already put in the trading instructions, so that does what we want it to do. Let's see what it spits out. Okay, now right now might not be a bad idea to pause the video so you can look at all the different metrics, because I'm not going to go over all of them. I'm just going to highlight some of the more important ones here. First thing that you should see up here is that there are 2,514 total trades, winning percentage of 51.8%. Let's see here. Total loss of $157,405. Average loss of $63 per trade. You know, so we lose money on average. Not great, but you know, it is what it is. Another thing here to look at is the largest win is $36,000. Now, you know, it's $250 a point, so a $36,000 move is a 144-point move. In this case, in your favor. If we look at largest loss, there's another $36,000 move. So, you know, we've had 144-point moves to the upside and the downside. If we were building a trading system here, which we're not, we're just trying to gather some information about what's happening to the market intraday. But if you were building a trading system, you'd want to have some sort of stop loss to protect you from these huge moves against you. And, you know, just simply by having a stop loss, it's going to dramatically improve the average profit per trade, the, you know, total net profit. That's why we use stop losses. You know, drawdown. If you're building a system, drawdown, something's always worth considering. You know, if you got a $421,000 drawdown, you're gonna need an awfully big account to be able to even take all these trades. Drawdown is simply how much money you could experience to the negative before you reach a new equity high in your account. So before going from, you know, $1 million to $1,001,001. You could have a $421,000 drawdown. That's huge. You know, some additional things that we can look at here is how it performed by year. You know, now I've looked at this before shooting this video, but one of the things I noticed earlier was that 2005 and 2007 we actually lost money taking these trades. But if you look at the S&P futures or the S&P's market in 2005 2007, they were actually up. So what that tells me is that in 2005 and 2007, that most of the profits or most of the gains were made overnight, not during the pit session, which is pretty interesting. You know, you can use that in a variety of different ways when building trading systems or trading scenarios. You know, 2008 was a brutal year in the markets, down 40%, and it's reflected here. You know, so another thing we can look at is how it performed by month. You know, there's a saying on Wall Street, sell in May, go away, right? If you look at May and then you look at June, June's our biggest loser. You know, maybe there's some truth to that. I don't know. But it's definitely interesting, and you can start to, you know, look at different things, you know. So another thing that's popular by some people is trading day of the week. You know, so let's go by weekdays, set it up so it shows the days here. So Monday, Tuesday, Wednesday, Thursday, Friday. You notice that Thursday and Friday are big losers. Is that something you want to consider when taking trades? I don't know. You know, there's something to it. Some people, you know, some people believe it, some people don't. I don't know. But it tests out pretty good here. So now there are a couple additional things that we can look at, but the main thing I want to do is just show you how you can get some additional insights from backtesting. In future videos, we're going to get a little bit more in depth into this and start to build trades. But for now, I just wanted to, you know, show you what's happening to the market intraday in the S&Ps, and then we're going to take some of these different scenarios, and we're going to use them as filters to actually build trading systems or trading scenarios that we might want to take advantage of. So for now, that's it, and thanks for watching.